Forget everything you learned about building credit. The 7 to 10-year rule is officially dead. In 2026, lenders no longer care how long your history is. They care about your future. A person with 20 years of perfect payments might be viewed as less secure today than someone with only 2 years of history, provided that 2 years are backed by a stable, AI-verified income stream. Think about why. The old model trusted time. It assumed that if you paid your bills for 2 decades, you'd keep paying them forever. But what if your job disappears next month? What if your business pivots? Time doesn't guarantee stability anymore. Technology does. Lenders are now prioritizing cash flow consistency over decades of records. Imagine you owe $20,000 on a high-interest card. Under the old system, your approval might hinge on how many years you've managed debt. In 2026, the question shifts entirely. They ask, can you prove you can service this debt consistently moving forward? If your payroll data shows steady deposits for the last 24 months, verified by real-time algorithms, that short, dense track record outweighs a long, thin one. Say you save $200 a month in your emergency fund. That discipline, combined with current income verification, signals a stronger ability to handle risk than a 20-year history with any gaps or volatility. Your past is just context. Your future cash flow is the contract. Lenders are betting on where the money is coming from right now, not where it came from 5 years ago. If your income is predictable and verifiable, your credit history length becomes less relevant. The game has changed, and the scorecard focuses on what's happening today and tomorrow, not yesterday. Think of your credit profile not as a museum exhibit of your past behavior, but as a live simulation running in real time. The core mechanism has fundamentally shifted from analyzing what you did to predicting what you will do. We are no longer just looking at static snapshots of your bureau reports. Instead, we are analyzing continuous data streams that tell us your habits. Imagine you have a history of paying utility bills on time. In the old system, that might just add a few points to your score. In 2026, that consistency becomes a direct signal of future reliability, effectively telling lenders, this person manages recurring obligations just as they manage debt. Consider a subscription service you've kept active for 3 years straight. That continuity isn't just a receipt. It's proof of financial discipline that outweighs a single missed payment from 5 years ago. Even your digital footprint matters. Say you consistently make online purchases within your stated income range, showing predictable behavior rather than erratic spikes. The scorecard now focuses on what's happening today and tomorrow, not yesterday. Your history matters less because the simulation weighs your current trajectory more heavily. If your recent data shows you are steadily reducing high-interest debt, the system simulates that path continuing, projecting a lower risk profile regardless of a blemish from a decade ago. It's about creating a dynamic forecast rather than a static record. The game has changed, and the scorecard focuses on what's happening today and tomorrow, not yesterday. Your ability to demonstrate consistent, forward-looking behavior is the new currency, making the sheer length of your credit history far less relevant. So, think of your credit profile less like a static report card from your past, and more like a live dashboard that updates in real time. In 2026, if you've been thin file, meaning you have little to no traditional credit history, you're no longer stuck in the dark. The systems now instantly pull in alternative data sources to build a robust profile within days of account opening. Imagine you're a freelance designer earning money through a gig platform. Every transaction showing consistent income and timely payments for your clients is analyzed. Or consider your mobile carrier. If you've never missed a bill and your usage patterns are reliable, that reliability gets factored into your overall score. These aren't just footnotes anymore. They're central to how your financial health is evaluated. Say you've been renting a car for the past year and always paid for fuel and maintenance on time. That consistency is now visible and valuable. The key shift is that your ability to demonstrate consistent, forward-looking behavior is the new currency. It's about what you're doing right now and what you're likely to do next, not just what you did 5 or 10 years ago. This means someone who just started their career or recently moved might find their creditworthiness established almost as soon as they open their first bank account or apply for a loan. The focus has moved from the depth of your history to the clarity of your current trajectory, making the sheer length of your credit history far less relevant. Imagine you've just missed a payment on your card. Under the old rules, that single slip-up would drag your score down for months or even years, like a permanent scar on your record. But now, the game has changed completely. We've moved into a rapid recovery standard where that missed payment no longer holds you hostage for the long haul. Instead of waiting years to heal, AI algorithms can reevaluate your risk rating within just 30 days if you take immediate corrective action. Think of it like this. Say you make a large cash deposit to clear your balance, or you set up a new automated salary deduction to prove your ability to pay. That's the trigger. The system sees the momentum, not just the mistake. It's like a car that was once out of fuel, one fill up and a steady drive, and you're back on the road in no time. The focus shifts from the depth of your history to the clarity of your current trajectory, making the sheer length of your credit history far less relevant. Your score now responds to what you're doing today, not just what happened 5 years ago. If you've cleaned up your act, the digital ledger reflects that speedily. So, if you've had a rough patch but have since demonstrated financial responsibility, you might find your credit health rebounds faster than ever before. This isn't just about paying back what you owe, it's about proving, in real time, that you're a reliable borrower again. The past still matters, but only as a snapshot of where you've been, not as a definition of where you're going. So, picture this. You're eyeing a new car loan, and instead of waiting for your monthly statement to arrive, the lender pulls your profile right now, down to the second. In 2026, your credit score isn't a static badge of honor or shame printed on a piece of paper. It's a live feed, updating in real time as your financial life happens. Think of it like a news ticker that never sleeps. If you make a purchase, your score ticks. If you pay off a bill, it ticks back. A missed payment today could lower your score instantly, not in 30 days, but immediately. Imagine you've just missed a payment on your credit card. In the past, you might wait for your statement cycle to close before seeing the impact. But now, that single late payment could ripple through your score within hours, affecting your ability to get approved for a loan or even a rental apartment. Conversely, imagine you've been saving diligently, paying off debt faster than expected. Your score doesn't just wait for the next cycle to reflect that effort. It climbs as you demonstrate responsible behavior day by day. This dynamic nature means your financial history is less about what you've done in the last 6 months and more about what you're doing right now. It's a constant conversation between you and the financial world, where every transaction, every payment, and every dollar spent contributes to a living, breathing number that evolves with your actions. Now picture the landscape of 2026 shifting beneath your feet. You've built a history that looks solid, maybe even impressive, but the rules have changed so that your past is no longer the primary currency you spend at the cash register. Instead, we are entering an era defined by the clean bill score, a new metric that fundamentally redefines what access means. Forget the old 300 to 850 scale that weighed your decades of payments against your recent mistakes. In this new system, your standing is determined almost entirely by your current liquidity and your immediate financial cleanliness. A clean bill isn't just about paying on time. It's about having zero open collections and minimal recent hard inquiries. Imagine you've just missed a payment last year, but then you aggressively cleared your balances, paid off your debts, and haven't opened a single new credit card in the last 6 months. In the old world, that missed payment might still drag your score down for years. In the 2026 clean bill reality, your score skyrockets because your current state is pristine. The system rewards the here and now. If you owe $20,000 at 22% interest, but are currently paying it down steadily with no new collections, you might score higher than someone with a perfect history who recently opened 5 credit lines and has 2 active collections. Your history fades. Your liquidity becomes the king. This creates a distinct tier of access where those who have cleaned their slate get priority treatment, while those burdened by recent noise or old, unpaid debts find themselves locked out regardless of their long-term track record. Think of your credit not as a static report card, but as a living ecosystem where the very definition of what counts as debt has shifted beneath your feet. Just a few years ago, every dollar in a loan was a liability, a weight you carried until paid off. But look closer at the numbers today. Imagine you owe $20,000 on a high-interest credit card at 22% APR. That same balance now drags your score down, signaling instability. However, picture the reverse. You've invested in a home battery system costing $15,000, financed at a low 4.5% rate. Under the new rules, that loan isn't just a liability. It's an active stability signal. Lenders see you as someone who has secured assets that protect their interest, making your monthly payment a promise of future value rather than just a drain on cash flow. This shift means the line between borrowing and investing has blurred in your personal finance profile. Say you've consistently saved $200 a month toward an electric vehicle. That payment history now contributes positively to your score because the asset itself is tied to a stable, long-term utility. Your history no longer matters in the old sense of just paying back a generic loan. Instead, it's about the quality and purpose of your current obligations. Those burdened by recent noise or old, unpaid debts find themselves locked out regardless of their long-term track record, while those who have aligned their credit with tangible, secure investments get priority treatment. The system rewards you for building a foundation, not just for cleaning up a mess. Think of your credit not as a static file, but as a living ecosystem that's finally starting to breathe again. Now picture the landscape of 2026. The old rules, where a thin file or a past hiccup meant instant rejection, are giving way to something far more dynamic called digital identity anchors. This isn't just buzzword magic. It's a fundamental shift where your unique digital footprint, your email history, the age of your domain, your consistent app usage patterns, serves as a primary credit anchor. Imagine you've just missed a payment last year, and your traditional credit report still shows that gap. Under the old system, you'd be stuck. But now, if that same user has maintained a perfect digital history for 3 years, secured a verified domain name 5 years ago, and shows consistent, responsible app behavior, the system recognizes them as low risk. Their digital trail tells a story of stability that outweighs a dusty old file. This allows a user with a perfect digital history to secure instant approval regardless of traditional credit file gaps. Banks and lenders are literally building new models where a robust digital presence acts as collateral. It's like walking into a high-end club where the bouncer doesn't just check your ID from 2015, but scans your entire digital biography to see who you really are. The result? A system that rewards you for building a foundation, not just for cleaning up a mess. You're no longer defined by your worst mistake, but by your current, verifiable digital character. So, you've built that solid digital foundation where your past mistakes no longer dictate your future. Now, it's time to actively engineer your profile. Think of your credit score not as a static report card, but as a living, breathing metric that updates in real time based on your behavior. In 2026, the difference between a good score and a great one often comes down to automation and visibility. Start by automating your bill payments, but make sure they go through a verified merchant. If you're paying utilities or subscription services, ensure the transaction is processed through a trusted platform that reports directly to the major bureaus. For instance, if you're juggling multiple loans, set up automatic transfers to a single, reputable payment processor that consolidates your history into a clean, verifiable record. This removes human error and ensures every on-time payment is instantly reflected in your dynamic profile. Next, create a credit health dashboard to monitor your real-time standing. Imagine pulling up a live feed that shows exactly how much your score fluctuated after a recent purchase or a new inquiry. This gives you immediate feedback, allowing you to tweak your strategy before it impacts your borrowing power. By keeping a close eye on these metrics, you transform your credit profile from a mystery into a managed asset. You're not just waiting for things to happen. You're actively shaping your financial identity with every automated payment and every check of your dashboard. So, think of your credit not as a static report card from 5 years ago, but as a live, breathing dashboard that updates in real time based on your current behavior. That shift is everything. Your history is still part of the picture, but it's no longer the whole story. What matters now is the rhythm of your cash flow and the consistency of your digital footprint. Imagine you've just missed a payment last month. In the old system, that single event might have dented your score for years. In 2026, that same miss is immediately contextualized. How long has it been since? What's your average daily balance right now? Are your other obligations being met automatically every cycle? The model cares less about the stumble and more about the recovery speed. This means you stop obsessing over how far back you've fallen and start focusing on how quickly you can stabilize. Picture yourself setting up an automated transfer that hits your lender the moment you get paid. That single action signals reliability faster than any past perfect payment ever could. You aren't just waiting for the algorithm to forgive you. You're proving your new reality with data. By stabilizing your cash flow and refining your digital identity, you unlock access to financing options that were previously out of reach, all while moving at a pace that matches your modern life. The ecosystem rewards momentum, not perfection. So, don't let yesterday's mistakes define your tomorrow. Start building a predictive profile today.